great ETF can still be a terrible investment.
Especially if you're only looking at the obvious fees and ignoring the real killer quietly draining your returns. Take a look at these two ETFs, QQQ and IJR. They're both popular. They've both performed well over time. But here's what most investors don't realize. Over the last 10 years, QQQ has returned nearly double what a broad market index like VTI did. That's not just a little better, that's a massive difference for your wealth. And yet many people still avoid QQQ. Why? Because of one number, the expense ratio. Let's dig into that. Most investors use the expense ratio, but they rarely use it well. It's supposed to help you avoid overpaying for an ETF, but it can also trap you into choosing the wrong one.
Let me show you what I mean. Over the last 10 years, from 2014 to 2024, the IJR ETF had an average annual return of about 8.5%, with a low expense ratio of just 0.07%. So if you had invested $100,000 into IJR back then, you'd have about $226,000 today. Not bad, right? Now let's look at QQQ, which has a higher expense ratio of 0.20%, but the return? A massive 17.5% average annual growth over the same 10 years. That means your $100,000 would have turned into over $507,000 today. Double the return for triple the fee. So, what's really going on here? The expense ratio is simply the fee you pay the fund manager for managing your ETF. It's how much you pay each year for investing in a particular ETF, and it's taken directly out of your returns. Here's a quick breakdown. If the expense ratio is below 0.10%, that's considered excellent. Between 0.20% and 0.50% is okay. Anything above 0.50% to 1% is usually too high, unless the performance clearly justifies it. While it's important, especially for ETFs tracking very similar underlying assets, many investors obsess over that tiny fee and ignore the much bigger danger: underperformance. From this example, it's clear. IJR has the cheaper fee, but QQQ massively outperformed, despite costing nearly 3x more in fees. Why? Because in the long run, the fee you pay doesn't hurt nearly as much as the returns you miss. If you're trying to minimize cost, you might actually be maximizing regret. This wasn't just a one-time example. This might be happening in your portfolio right now. That favorite ETF of yours, the one with the cheap fee you've been holding for years, it could be quietly underperforming, dragging down your long-term returns without you even realizing it. Not because it's a bad investment, but because you fell into the trap. The low-fee hype, the brand name hype, the safe-sounding labels. But you never stop to ask, what's actually inside this ETF? What companies am I investing in? Does this fund even match the kind of growth I need? So if expense ratios aren't the whole story, how do you accurately measure an ETF's potential? What metrics truly drive its performance? Before you put your money in, here are the crucial factors you need to consider to avoid falling short on your returns. Let's use QQQ as our example to show you how to identify a good ETF. Step 1. Look at the top holdings. To start your research, visit a financial website like Morningstar or Yahoo Finance. Search for the ticker symbol, for example, QQQ. While you'll see a lot of data, we need to go deeper. Find the top 10 holdings section. These companies typically represent 30 to 70% of the ETF's value and are the primary drivers of its performance. Ask yourself, are these quality companies with strong fundamentals? Are they concentrated in one sector? This helps you understand the concentration risk and ensure your portfolio is well diversified. Do the holdings match your investing goals? Are you already holding these companies elsewhere? For an ETF like QQQ, its top holdings include Apple, Microsoft, and Nvidia, all large-cap tech growth stocks. If you already own those individually, adding QQQ might significantly double your exposure to the tech sector. Next, look at the ETF's performance over the last 10 years. Don't just look at year-to-date returns. Review 1-year, 3-year, 5-year, and 10-year returns. Compare it with benchmark indexes, e.g. S&P 500 or NASDAQ 100. Compare it with similar ETFs in the same category. For QQQ, you'll see it has produced great results over the last decade and consistently outperformed many other ETFs in its sector. These are the metrics that indicate a truly outperforming ETF. If your ETF consistently underperforms the S&P 500 for 5 years with similar risk, that's a definite red flag. And finally, don't just buy an ETF because it's popular or has a fancy name. Ask yourself, what's the real game plan here? What is this ETF actually built to do? For example, if it's cap-weighted like QQQ, it means the biggest companies dominate the fund. So your returns will mostly follow the performance of the top names like Apple or Microsoft. If it's equal-weighted like RSP, every company gets the same slice of the pie. This spreads out the risk, but also means smaller companies have more influence on your returns. Then you've got thematic or active ETFs, like ARKK. These go all in on specific trends or rely on a fund manager's strategy. They can swing more wildly, bigger gains if they get it right, but also higher risks. So always check, is this ETF tracking a broad market index, a specific niche, or is it actively managed? Knowing the strategy helps you understand why it moves the way it does, and if it actually fits your goals. So before you fall in love with a fund, look deeper than the fee. Look inside the ETF, because that's where your returns are really made or lost. And here's the best part. All this information, it's public, it's online, it's everywhere. You just have to know where and what to look for. But if digging through charts and ETF reports feels like too much work, don't worry. That's exactly why we built this channel. We do the digging, you get the cheat codes. So hit that subscribe button if you're tired of guessing and ready to grow smarter.